At a certain point, the leverage demands.
But the fact that they can still raise capital, I understand this skepticism. I do. The volatility increasing the Bitcoin yield per share. They have targeted hitting on a swing. These are the pillars of traditional finance.
To fund the $84 billion
It is volatile, absolutely. But
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
average daily trading volumes are exceeding 23 million shares. The stock is currently trading 70% below its November 2024 all-time high of $543. Bitcoin itself has crashed from its $126,000 peak in October of 2025 down to the mid-$60,000 range. And off-exchange short volume ratios, well, they're sitting at nearly 48%. Just to put a really fine point on that, 3.9 million shares were shorted off-exchange on March 3rd alone.
The numbers are they're staggering.
They really are. When I looked at the terminal this morning, I had to take a long pause. These aren't just digits flashing on a screen. They represent a crucible. We are looking at raw market data as of early March 2026, data that tells the story of an unprecedented financial experiment undergoing its most severe stress test to date. I am speaking, of course, about Strategy Inc., the entity formerly known as MicroStrategy.
Right. Following that formal rebranding back in August of 2025, they really tried to draw a line in the sand.
Exactly. They fundamentally alter their corporate DNA. We aren't talking about a legacy software business anymore that just, happens to hold some digital assets on the side. We're looking at the execution of a staggering $84 billion initiative, the 4242 Capital Plan. It was designed to completely institutionalize a corporate Bitcoin treasury. They now hold over 720,000 Bitcoin. And my position today, looking at this wreckage, is that despite the brutal 70% drawdown in share price, and frankly, despite the geopolitical shockwaves of the ongoing US-Iran war, Strategy Inc. has actually succeeded. They have engineered something entirely new here, a permanent, unassailable digital central bank model. The recent market stress we are seeing, I'd argue it actually proves the resilience of their highly diversified digital credit stack.
Well, I come at it from a very different way. And frankly, when you look beneath the surface of that massive treasury, the mechanics tell a much more alarming story. I argue that this model is fundamentally precarious. It isn't a central bank. It is a highly leveraged structure balanced on a knife's edge. That entire $84 billion capital plan you just mentioned, it relies completely on an equity premium, what they call the MNAV, the market cap to net asset value. And right now, that premium is collapsing. It exposes the severe, almost existential fragility of trying to use a wildly volatile digital asset as permanent capital while funding it through continuous financial engineering.
I understand the skepticism. I do. The volatility it's violent. But let me give you a different perspective on how entrenched this model has actually become within traditional finance. If we look at the institutional positioning, it's undeniable at this point. Vanguard currently holds roughly 9% of the company. Bank of America increased its position by 680% in late 2025 alone.
But we really have to ask why they hold it.
Let me just finish the thought on the positioning because it matters. These are not day traders speculating on a swing. These are the pillars of traditional finance structurally integrating Strategy Inc. into their portfolios. Now, I know the headline numbers look terrifying to some. The company reported a massive $12.4 billion GAAP loss in February of this year. But we have to be precise here and unpack what that actually means, because it is merely a non-cash accounting artifact.
Right, the new FASB rules.
Precisely. It was triggered directly by the FASB ASU 2023-08 rules. For those following the granular accounting changes, this rule requires digital assets to be marked to their current market value. Think of it like owning a house. The real estate market dips, and suddenly the government forces you to declare a massive loss on your income statement. Even though you still live in the house, you haven't sold it, and you have absolutely no intention of selling it. That is what happened to Strategy Inc. It doesn't impact their operational reality one bit.
Look, I'll grant you that the GAAP loss is an accounting quirk. It's paper. But a house doesn't underpin an $84 billion leverage loop.
Fair, but their operational heartbeat is actually stronger than ever. Let's not forget the core software business, cloud subscription revenue, just surged 62%. And more importantly, to weather this exact kind of macro storm, a war, a crypto crash, they successfully established a $2.25 billion USD reserve. That cash buffer ensures they won't have to sell a single Bitcoin to service their debt for up to 3 years. They have functionally insulated the treasury.
The cash reserve is a fair point, but I think we need to zoom out and look at the underlying mathematical reality of how that treasury is actually funded. Yes, the scale of the holdings is massive. Over 720,000 Bitcoin is second only to Satoshi Nakamoto's dormant wallets. That is an astonishing accumulation of capital. But we have to focus strictly on the mechanics of their stated goal, what they call the Bitcoin yield, and that MANV metric I mentioned earlier. Let's translate that for a second so we're clear on why it matters.
Go ahead.
Historically, this company traded at a massive premium to the Bitcoin it actually held, an MNAV of 2.0x, sometimes even 3.0x. This means the market was willing to pay $2 or $3 for every $1 of actual Bitcoin sitting on the company's balance sheet. That premium, that was the magic trick.
It was a highly effective mechanism for capital formation.
It was. It allowed them to issue highly priced stock, take that cash, buy Bitcoin, and accretively increase the amount of Bitcoin per share for the existing shareholders. It was a beautiful flywheel, as long as the premium existed. But here we are in early March 2026, and that MNAV has compressed drastically. It's sitting roughly between 0.99 and 1.19. The premium is essentially gone, therefore trading at parity.
Which is a natural stabilization as the market matures.
But without that massive premium, the cost of equity required to fund the $84 billion 4242 capital plan becomes completely paralyzing. The magic trick is over. The flywheel stops, and the broader market recognizes this fragility, which is exactly why the stock is currently the most shorted large-cap U.S. stock on the market. Short interest is at 14% of its $41.6 billion market cap. The market is aggressively betting against the viability of this leverage loop.
Let's unpack that short interest, because I think it is being fundamentally misinterpreted. You look at 14% short interest and you assume it's a structural rejection of the company, a bet that the whole thing comes crashing down. But I look at the aggressive first quarter 2026 accumulation and see the exact opposite. Capital International increased their stake by nearly 65% in February. The South Korean National Pension Service is actively expanding its exposure. These entities are explicitly choosing Strategy Inc. as their definitive global proxy for digital gold. They are buying the dip. The institutional conviction is actually deepening during this crypto winter, precisely because Strategy Inc. provides a level of scale and yield that no simple spot ETF can offer.
I have to stop you there, because I think you're misreading what that volume actually is. I just don't buy that interpretation of the institutional buying.
Why not? The filings are public, the shares are being acquired.
Because you're looking at those massive daily volumes, the 23 million shares trading hands, and you are assuming it represents long-term conviction in Strategy Inc.'s vision. I look at those exact same volumes combined with the heavy use of dark pools, and I see something entirely different. I see the basis trade.
Ah, the arbitrage strategy.
Exactly. We know from the data we cited at the top of the hour that nearly 48% of the short volume is happening off exchange. In late 2025, we even saw the launch of Go Dark, an institutional crypto dark pool backed by Copper and GSR. It was built specifically to handle these massive block trades out of the public eye. Let's explain what the basis trade is in plain English. Think of it like buying a rare collectible for $100 in one store while simultaneously selling an IOU for that exact same collectible to the guy next door for $110. You don't care about the collectible. You just want to lock in that $10 difference risk-free.
So you're arguing the institutions don't care about the company at all?
Exactly. What is actually happening is that sophisticated institutions, firms like Jane Street, who just increased their holdings by 16%, are shorting Strategy Inc. stock while simultaneously buying spot ETFs like BlackRock's IBIT. They are simply arbitraging the premium. They are entirely indifferent to the company's long-term corporate vision. They are just extracting the spread between the equity value and the net asset value. They aren't betting on the digital central bank, they're just playing the math.
That is a fascinating dynamic to highlight, though. I would frame its impact differently.
Let's say you are entirely correct. Let's say a significant portion of that volume is driven by arbitrageurs capturing the basis. My counter to that is, it doesn't matter. That liquidity actually serves the company's broader capital strategy, regardless of the trader's intent. Strategy Inc.'s financing has evolved leagues beyond simple debt or equity issuance. We have to look at the efficacy of their digital credit stack.
You're talking about the new preferred stock instruments.
Specifically, yes. Instruments like the STRC, they're variable rate perpetual preferred stock. I know that is a mouthful of financial jargon, but we have to look at what it actually does. This is a masterclass in corporate finance. It has a rules-based monthly yield that was just raised to 11.5% in March.
Which is a massive yield to pay out.
It is, but look at the function. That variable rate specifically strips away the price volatility of the underlying Bitcoin, making the instrument highly attractive to traditional income-focused institutions who want the yield but cannot stomach the crypto swings. And what did that instrument allow Strategy Inc. to do? During the absolute darkest days of the Q1 crypto winter, between late February and March 1st, while everyone else was panicking, they comfortably acquired another 3,015 Bitcoin at an average price of $67,700. They are using this highly sophisticated capital stack to ruthlessly accumulate the asset at cycle lows.
I will concede the ingenuity of the STRC instrument. Creating a perpetual variable yield preferred stock to fund Bitcoin acquisition, it's undeniably innovative. I won't take that away from them. But, and this is a massive but, it completely glosses over the looming ticking time bomb in their older, traditional debt structure.
You mean the convertible notes?
Yes. You mentioned they're accumulating right now at $67,700. But we cannot forget that their total average cost basis across the entire 720,000 Bitcoin treasury is roughly $75,985.
They are temporarily underwater on the aggregate position.
They are deeply underwater. And that brings us to the 2030 0% convertible notes. Yes, they are zero interest, which sounds great on paper, but they contain a holder put option in March of 2028. This means bondholders can demand early repayment at par value. They can ask for their cash back. If the macro environment, which has been severely exacerbated by this horrific US-Iran war, keeps Bitcoin suppressed below that $75,000 threshold, how do they meet that redemption? At a certain point, the leverage demands liquidity.
They meet that redemption through the very structure they have spent the last year fortifying. When Michael Saylor stated plainly in February that the company has liquidity for the next 70 years, I know a lot of analysts scoffed at that as pure rhetoric, but it isn't. It is mathematically backed by that $2.25 billion cash reserve they established. Let's play out your doomsday scenario. Even if every single holder of the 2028 put option demanded their capital back, that reserve buys them years of runway without forcing a single liquidation of their Bitcoin holdings.
Assuming the reserve isn't depleted by other operational shortfalls or higher yield payouts on instruments like the STRC.
The software business covers operations. The structure is specifically designed to survive this exact type of multi-year crypto winter. By continuing to execute ATM at-the-market sales and buying the dip, they are systematically averaging down their cost bases. And at the same time, they are increasing the Bitcoin yield per share. They've targeted a 30% Bitcoin yield for 2026. This means every individual share of Strategy Inc. represents 30% more underlying Bitcoin than it did a year prior. The engine is still working.
But that entire engine assumes the broader macro narrative holds up, and frankly, the events of early 2026 have severely fractured that narrative.
How so?
The ongoing US-Iran war proves something very uncomfortable for the digital gold thesis. Bitcoin did not act as a risk-off safe haven in the way traditional gold historically has. When the war broke out in late January and geopolitical panic set in, capital fled from digital assets just as fast as it fled from high-beta tech equities.
Let's define high beta for a moment so we are on the same page.
Sure, high beta essentially means an asset is highly correlated to the broader market, but with much more extreme swings. It just moves exactly like the riskiest, most speculative tech stocks, only faster and harder. When the market gets scared, High beta assets are the first things sold to raise cash. Bitcoin acted like a high beta tech stock, not a safe haven. If that macro narrative fails permanently, if the institutions integrating Strategy Inc. realize that Bitcoin is just a high beta liquidity sponge rather than a geopolitical vault, then that $8.2 billion in outstanding senior convertible notes becomes a terrifying ticking clock. In that scenario, the $2.25 billion cash reserve you keep pointing to, it is nothing more than a temporary band-aid on an arterial wound.
I see the concern, but I am not convinced by that line of reasoning because it treats a temporary liquidity shock as a permanent structural failure. Let's look at history. The initial flight to cash at the onset of a major global conflict is a well-documented phenomenon across all asset classes. Even traditional gold suffered severe drawdowns during its early financialization phases when macro shocks hit. People panic. They sell everything to get dollars. It doesn't mean the thesis is dead.
But gold eventually stabilized and acted as a hedge. Bitcoin went from 126,000 down to the mid-60s. That is a catastrophic drawdown for a reserve asset.
It is volatile, absolutely. But Strategy Inc. isn't managing this treasury for a 3-month geopolitical shock. They are managing for the decade-long devaluation of fiat currency. They are transitioning from a legacy software company to a decentralized digital bank. And we have to acknowledge what they have actually achieved here. Their capitalization structure has weathered an extreme market stress test, a 70% drawdown in their own stock, a 50% drawdown in the underlying asset, and a major regional war, all without facing margin calls or forced liquidations.
Because the debt isn't due yet.
But the fact that they can still raise capital, issue preferred stock, and acquire over 3,000 Bitcoin during a war and a crypto crash is precisely the proof of concept. The market is still funding them. They have permanently altered the boundaries of corporate finance.
The market is funding them right now, yes. But the mathematical reality of a compressed MNAV simply cannot be ignored by brushing it off as a temporary shock. When you have an $84 billion capital plan that mathematically requires a functional equity premium to survive, and that premium evaporates down to parity, the cost of equity becomes prohibitive. You add to that the staggering short interest we discussed. The market is severely questioning the viability of this leverage loop. If Bitcoin's price doesn't organically bail them out, if it doesn't cross back over that $75,000 cost basis, the financial engineering will begin to consume the enterprise. The math always catches up with the leverage. It always does.
Yet, that exact short interest you point to as their greatest weakness could easily become the catalyst for an unprecedented upward repricing. We have to look at the market microstructure right now. The days to cover ratio is currently sitting around 2.24 days.
Explain what that implies for the market.
The days to cover ratio essentially measures how long it would take for all the short sellers to buy back the stock they owe based on average trading volume.
The tension is indeed immense. I will certainly agree with you on that. You have this potential for a mechanical short squeeze on one side, a purely structural market event, and on the other side you have genuine existential risks of funding a deeply underwater digital treasury in a wartime macro environment. It is a high-wire act with $84 billion on the line.
It is the defining financial experiment of our era. Strategy Inc.'s execution over the next 12 months isn't just about their own balance sheet anymore. It is about whether this model, this highly engineered integration of digital assets and traditional capital markets, becomes the visionary standard for national and corporate reserve management globally.
Or whether it ultimately reveals itself to be a fragile arbitrage target that was undone by its own complexity. That remains the defining question of 2026.
We will leave that ultimate conclusion to you, the listener. The rules of corporate treasury are being rewritten in real time, and the data will continue to unfold.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!